Welcome back to the Elite Economizer, where we dissect the intricate workings of finance and equip you with the knowledge to navigate the economic landscape. Today's episode delves into a recent decision by the Federal Reserve, a choice with significant ramifications for your financial well-being. The Federal Reserve, often referred to as the Fed, surprised many by holding off on lowering interest rates. Their primary concern, a resurgence of inflation, evident in the lack of progress towards their coveted 2% target. This decision carries immense weight, considering the ripple effects Fed actions trigger across the entire economy. Let's dissect the implications for you, the individual investor. A future interest rate cut by the Fed would be transformative. From the bustling housing market to the volatile stock market, and even the burgeoning cryptocurrency sector, the potential impacts are wide-ranging. However, there's a crucial twist. The real story lies in the subtle shift towards a return of easy money, a policy slated to begin in June. That's right, folks. Easy money is back on the menu, albeit in a measured approach. This marks a departure from quantitative tightening, a strategy where the Fed actively reduced the money supply to combat inflation. The easing of these measures signifies a calculated willingness to tolerate slightly higher inflation in pursuit of other economic goals. But what exactly does this change entail? Previously, the Fed tightened monetary policy by withdrawing a staggering $95 billion a month from circulation. This aggressive approach has now been scaled back to $60 billion. While seemingly incremental, this decrease reflects the Fed's growing concerns about rising interest rates on Treasury bonds. Now, let's delve into the strategic implications. Lower interest rates typically stimulate economic activity by making borrowing more affordable. This, in turn, fuels demand and potentially drives prices upwards. However, this strategy becomes a double-edged sword in an environment already grappling with inflation. Throughout 2024, inflationary pressures have shown signs of reacceleration, posing a significant challenge to the Fed's objectives. Consumer Price Index (CPI) inflation lingers around 3%, and core inflation, which removes volatile food and energy prices, is also on the rise. This presents the Fed with a dilemma. While lowering interest rates might appear like a convenient solution, it could inadvertently exacerbate inflationary pressures. Consider the housing market, a sector heavily influenced by interest rates. Lower rates could ignite a surge in demand, pushing house prices even higher. This scenario, beneficial for sellers, could leave aspiring homeowners locked out of the market. Here's where the plot thickens. While the Fed portrays a narrative of a robust consumer, economic data tells a different story. Gross domestic product (GDP) growth has stagnated, and personal spending, although up, is accompanied by rising expenses. This translates to squeezed household budgets, a reality many Americans are grappling with. The dissonance between the Fed's portrayal of the economy and the lived experiences of everyday citizens raises concerns. It highlights the delicate balancing act the Fed is undertaking. Their decisions must promote economic growth without neglecting the harsh realities of rising costs and stagnant wages. Looking ahead, the million-dollar question remains: when will the Fed finally pull the trigger on rate cuts? While the possibility is unlikely for June, the odds could shift in subsequent meetings. When they do cut rates, we can anticipate a temporary boost to the economy, accompanied by the specter of heightened inflationary pressures. This is a precarious tightrope walk for the Fed, with the potential to shape the financial landscape for years to come. So, let's get a conversation going. What are your thoughts on the Fed's recent moves? Do you believe they'll stick to their plan, or will they be forced to adapt in the face of growing challenges? Share your insights and join the discussion in the comments below. Remember, staying informed and empowered is key to navigating the ever-evolving world of finance. Until next time, this is the Elite Economizer, signing off.